Hi, I'm Isham and welcome to our presentation video. So enjoy the video. Hi, my name is Norisha Marif bin Soimi. My matrix number is 20DAT34 F1067. That's all.
Hello, my name is Bernard Junior Q Kong Kui, and my matrix number is 20DAT24F1075.
Hello there.
My name is Gavin Petrus. My matrix number 20 D1824 F1020.
Hello, my name is Muhammad Razli. My class is DAT4A and my number matrix is 20DAT23F2005. Hi, so today I am going to explain you all about the basic concepts of costing principle. Okay, for the first one, a cost unit. A cost unit is the unit of product, service, or time for which costs are measured and expressed. It helps in determining the total cost per unit of output. For example, cost per ton of steel and cost per liter of milk, cost per passenger kilometer in transport. Yeah. The next one, cost center. A cost center is any location, department, person, or a piece of equipment for which costs are collected and controlled. It allows management to track expenses more effectively and assign responsibility for controlling costs. For example, production department and maintenance section. Yeah. The third one, cost object. A cost object is anything for which separate measurement of cost is desired. It could be a product, a service, a customer, a project, or even an activity. Example, a product, a project, a service, or a customer. The next one is conversion costs. Conversion costs are the expense incurred to convert raw materials into finished product. For example, wage of workers, operation machines, factory electricity bills, and machine depreciation. So the rest of this will be explained by my friend Bernard. So that's how it's done. That's all from me. Thank you.
And I will be presenting about opportunity cost. Opportunity cost represents the benefit or income lost when one alternative is chosen over another. It helps management in decision making by considering the value of the foregone option. For example, it helps management in decision making by considering the value of the forgotten option. Next is incremental cost. Incremental cost refers to the additional cost incurred due to an increase in production, sales, or activity. It focuses only on the extra cost, not the total cost. For example, if producing 1,000 units cost 50,000 ringgit and producing 1,200 units cost 58,000 ringgit, the incremental cost for the 200 extra units is 8,000 ringgit. Next is replacement cost. Replacement cost is the current cost of replacing an existing asset with a new one of similar type and capacity. It helps businesses in planning capital expenditures and insurance. For example, the cost to buy a new machine in today's market to replace an old worn-out one. Next is sunk costs. Sunk costs are the past costs that have already been incurred and cannot be recovered. These costs should not influence future decisions since they remain unchanged regardless of the choice made. For example, money spent on old research, obsolete machinery, or training programs that cannot be undone.
For question 2 is about accumulation and assignment of costs for different functions that focusing on product cost, period cost, fixed cost, variable cost, semi-variable cost, controllable cost, and uncontrollable costs. First one is a product cost. Product costs are inventoryable costs, the cost incurred to manufacture a product and get ready for sales. As example in the cost statement is a direct material, direct labor, and manufacturing overhead. Product costs are directly linked to the production process and are initially recorded as inventory on the balance sheet. When the goods are sold, these costs are transferred to the cost of goods sold (COGS) on the income statement. Understanding product costs helps in picturing, budgeting, and measuring production efficiency. The second one is about a period costs. Costs that are not attached to the production process and are expenses in the period they are incurred. As example, in cost statement, it's about administrative overheads, selling and distribution costs. Period costs are expenses that are not tied to the productions. These costs are expenses in the period incurred rather than being included in inventory or product costs. As example are the manager's salary or sales commissions. The third one is about the fixed costs. In cost and management accounting, fixed costs are costs that are remain unchanged regardless of the level of production or sales volume. These costs are incurred consistently over time and do not vary with output. As example in the cost statement is about the insurance and rental. Fixed costs are essential for budgeting and break-even analysis, helping businesses understand their baseline financial obligations. The fourth one is about a variable cost. Variable costs refer to expenses that change directly and proportionally with the level of production or sales activity. The more units a company produces, the higher total variable costs. If production drops, the costs are decreased. As example in the cost statement is about raw material and a direct labor. These costs are crucial for marginal costing, cost volume profit analysis, and decision making as they help business determine how costs behave with change in activity level.
Okay, my part is E. Semi-variable cost. Definition: cost containing both fixed and variable components. Accumulation and assignment accumulate in a mixed cost pool, separate using height, low, or regression. Assign fixed portion via allocation based and variable portion via unit activity driver. For example, utility bill with base charge plus per kilowatt uses maintenance contract with fixed antenna per call charge. Next, F. Variable cost. Definition: cost that a specific manager can influence within a given time horizon. Accumulation and assignment accumulate by responsibility center, department manager assigned to that center for performance evaluation, responsibility accounting. For example, department suppliers overtime approval, scheduling temporary workers, advertising spend, approved by the sales manager. Last, uncontrollable cost. For definition, cost that a specific manager cannot influence in the short run. Accumulation and assignment accumulate separately from controllable costs assigned for reporting but exclude from the manager's performance evaluation. For example, corporate IQ allocation, long-term holding list signed by head office, statutory rates tax, depreciation method set by policy. This is all for me. Thank you.
Okay, that's all from our presentation. So thank you for watching this video.
and I hope you guys all understand about this video, about the presentation, and that's all from us. Thank you. Bye bye.